Welcome to the deep dive.
Glad to be here.
You are a resident learner, and today we have an absolutely incredible stack of material to get through.
We really do?
Today is February 28th, 2026.
Right.
And our mission today is to synthesize a massive stack of today's financial and business news.
We're drawing this directly from the Business Standard, Mint, and the Economic Times.
Exactly. And we're going to turn all of that into a cohesive, high-yield briefing just for you.
Because there is a lot of noise out there right now.
So much noise, so we are filtering that out.
We're focusing entirely on the macroeconomic shifts, the technological earthquakes hitting the markets right now.
And the shifting geopolitical trade winds.
Yeah.
We want to extract everything crucial for an investor or a business leader who is, trying to navigate today's landscape.
It's a complex landscape.
It is. I mean, imagine waking up to find the fundamental math of your economy has been completely rewritten.
Right.
While simultaneously, a core pillar of your stock market has suffered its worst month since the 2008 financial crisis.
Which is exactly what happened today.
It's wild. It is just wild.
It is a profound convergence of events, honestly.
Yeah.
While the headlines might be screaming about, volatility and sudden drops.
And there are a lot of those headlines.
There are. But looking closely at the data reveals this fascinating structural transition.
Okay, unpack that a bit.
Well, we are seeing a fundamental shift in both India's economy and the global technology landscape.
So it's not just noise.
No, it's not just noise at all. It is a recalibration.
Or recalibration.
Yes, we need to look past the immediate shock value of a stock index dropping or a GDP number changing.
Right, and understand the actual mechanics driving these events.
Exactly. Our goal today is to break down those underlying forces.
So you, the listener, can position yourself strategically for the long term.
Precisely.
Okay, let's jump straight into the biggest headline of the day.
The macro ledger.
A macro ledger, yes, and the rewriting of India's economic math.
This is a huge one.
The government just released a new national account series.
They've rebased the gross domestic product, the GDP, to the year 2022-23.
And we are looking at a massive paradox here.
A very interesting paradox.
Real GDP growth for the financial year 2026 has been revised upward.
To a three-year high of 7.6%.
Right, and the third quarter growth was a very firm 7.8%.
Which looks great on paper.
It does, but at the exact same time, the nominal GDP base...
The actual currency value of the economy.
Right, the nominal base was revised downward.
Yes. It went from an estimated 357.13 trillion rupees
down to 345.47 trillion rupees.
That is a significant drop in the absolute size.
So, just so I have this right, the economy is growing faster in real terms, but the absolute size of the pie in nominal terms is suddenly smaller than we thought yesterday.
That's exactly it.
I have to ask, as someone who watches these numbers very closely,
Sure.
Isn't it a bit convenient that rebasing the math magically yields a 3-year high in growth right before the end of the fiscal year?
It's a fair question.
How much of this is real value and how much is just, statistical gymnastics?
That is exactly the skepticism an investor should bring to any structural data revisions.
Right.
To understand whether it's gymnastics or genuine clarity, we really have to look at how the sausage is made here.
Okay, let's look at the sausage.
The previous base year was 2011-12.
Wow, okay. That's old.
Think about how much the Indian economy has changed since 2011.
Entirely different world.
Exactly. Back then, the digital economy, UPI, formalization, all of that was in its infancy.
True.
The old series relied heavily on annual enterprise surveys that lagged by years.
So they were basically guessing based on old data.
To an extent, yes.
Yeah.
Now, the new 2022-23 base integrates high-frequency, comprehensive goods and services tax, or GST, transaction data.
Ah, okay. That makes a big difference.
It does. It is pulling real-time economic activity into the calculation.
Rather than relying on delayed surveys and broad estimations.
Yes, so the upward revision in real growth is likely a much more accurate capture of formal economic activity.
Activity that simply wasn't being tracked properly under the old methodologies.
Likely.
That makes sense. The old net just wasn't woven tightly enough to catch the new digital fish.
That's a great way to put it.
But let's unpack this paradox of real growth going up while the nominal GDP base shrinks.
Right, the shrinking pie.
It's like stepping on a newly calibrated scale and finding out you are leaner and running faster, but you actually weigh a bit less overall.
Yeah.
How does that happen mechanically?
Well, to carry that scale analogy forward, if your total weight is lower, Suddenly your body fat percentage might look a lot more dangerous as a fraction of the whole.
Oh, I see where this is going.
That is the fiscal impact we are seeing today.
Because nominal GDP is the absolute denominator for almost every critical macroeconomic ratio.
Everything the government and bond markets care about.
Right.
When that denominator shrinks from roughly 357 trillion to 345 trillion rupees, the math turns against the government.
The immediate casualty is the fiscal deficit.
Yes. Because the denominator shrank, the fiscal deficit automatically ticks up to 4.5% of GDP for FY26.
And that's up from the 4.4% that was penciled into the union budget just a short time ago.
Exactly. Similarly, the debt to GDP ratio gets pushed up to 58%.
So the government didn't actually spend more money or borrow more money overnight?
No, not at all.
The pool they're measuring that debt against just got shallower?
Precisely. The Bank of America research note we reviewed pointed out that this downward revision in the nominal base was highly unexpected.
Because everyone assumed inflation would push it up.
Exactly. Most analysts assumed the new base would revise the nominal size higher due to inflation over the past decade.
So what did the government say about this?
The chief economic advisor, Nathan Nageswaran, came up very quickly
They do some damage control.
to state that this doesn't alter the actual fiscal trajectory or borrowing limits of the government in absolute rupee terms.
Which is technically true.
It is technically true, but optically and mechanically, for bond investors who trade on these percentages,
It requires a steeper consolidation path going forward.
yes, to meet international rating agency expectations.
I want to dig into the why behind the manufacturing numbers, because this is where the new math looks wildest to me.
It is a massive change.
The new series introduces something called double deflation in manufacturing.
Yes, double deflation.
Our sources show that under this new methodology, the manufacturing sector suddenly looks like it's on steroids.
Posting double-digit growth for 5 consecutive quarters.
Yeah. What exactly is double deflation, and why does it change the picture so drastically?
This is perhaps the most crucial technical upgrade in the news series.
Okay, lay it out for us.
Let's break down the difference between gross domestic product, GDP, and gross value added, or GVA.
Okay.
GDP is what we all talk about, right? It's the total value of goods and services produced, plus taxes minus subsidies.
A headline number.
Right. But GVA is the true measure of economic activity at the factory gate.
Before the government gets involved.
Exactly. To calculate GVA, you take the total output of a factory and subtract the intermediate inputs.
Like the raw materials, the energy used.
Yes.
So profit, essentially, the actual value you added to those raw materials.
Exactly. Now, in the old series, India largely used single deflation.
Single deflation.
That means they would take the final value of the output and adjust it for inflation using a broad wholesale price index.
Okay, that sounds normal. What's the problem?
Think about a real factory.
Yeah.
Let's say you manufacture automobiles.
Oh, I'm making cars?
Over the last year, the price of your intermediate inputs, steel, lithium, shipping, might have skyrocketed.
Due to global supply chain issues, yeah.
But you couldn't pass all those costs on to the consumer, so car prices stayed relatively flat.
Right.
Single deflation doesn't capture that squeeze accurately. It just deflates the output.
I see.
Double deflation, which is the global gold standard, by the
Yeah.
way, adjusts both the gross output and the intermediate inputs for inflation separately.
Using different specific price indices?
Yes, before calculating the gross value added.
So by using double deflation, the statisticians are stripping out the extreme volatility of input costs, like energy spikes,
Right.
just to see the actual real volume of value being created on the factory floor.
Yes, and the result of doing this is staggering.
It really is.
The manufacturing sector's growth was completely underreported in the old series.
Where it averaged just 6.3% over in previous quarters?
Exactly. Under the new 2022-23 base, because they're finally measuring the value addition accurately through double deflation and GST data.
Manufacturing is printing at 13.25% in the third quarter alone.
It fundamentally changes our understanding of India's industrial engine.
It really does. And it's not just manufacturing that got reshuffled in this new math.
No, the entire sectoral composition shifted.
I was reading the breakdown, and agriculture's share of the GDP actually rose.
From 16.1% to 17.4%.
Manufacturing bumped up from 12.9% to 13.3%.
Yeah.
And services, which has been the undisputed heavyweight champion of the Indian growth story for 2 decades,
Actually slipped,
it slipped from 50% down to 48%.
which is huge.
Every investor who has built a portfolio based on the assumption that India is overwhelmingly a services-led, post-industrial economy has to immediately look at their thesis.
The structural implications of that are massive.
Yeah, absolutely.
The increased weight of agriculture and manufacturing suggests that the government's aggressive push for industrialization, like the production links incentive scheme,
See the lie schemes, yeah?
they might be having a more profound baseline impact than previously measured.
That's the bullish take.
It is, but it also highlights the vulnerability of the economy to rural distress.
How so?
Well, even though agriculture's share of the economy is higher in the new base, its actual gross value-added growth slowed down significantly.
Down to a mere 1.4% in the third quarter.
Yes, it is projected at just 2.4% for the full year, despite an adequate monsoon.
That is a glaring underperformance.
In a sector that still employs nearly half of the nation's workforce.
You cannot have sustainable 7% plus GDP growth if the sector employing half your population is growing at 2%.
You simply can't.
That leads perfectly into the demand side of the equation.
Let's talk about demand.
If the rural sector is dragging, who is doing the spending?
That is the billion-dollar question.
We saw the Prime Minister making a very direct, almost urgent appeal to India Inc. this week.
He called for a reform partnership charter.
Between the government, industry, lenders, and academia.
The subtext in the reports there is fascinating.
The government has essentially been doing the heavy lifting for a decade.
Public capital expenditure has grown 6 times over.
From 2 trillion rupees to over 12 trillion rupees in 11 years.
They've built the highways, the ports, the digital infrastructure.
But the government can't keep maxing out its credit card.
No, and the data proves that point. Government final consumption expenditure is flattening out.
It's projected to grow at just 6.6% in FY26.
The fiscal consolidation path we discussed earlier demands this moderation.
So the baton absolutely must pass to the private sector.
It has to. Private final consumption expenditure is accelerating to 7.7%, but consumption alone creates inflation without corresponding supply.
So the Prime Minister is making it very clear.
Corporate India needs to step up and invest in massive capital expenditure, or CapEx.
But will they?
That's what everyone is watching.
Because the chief economic advisor is highly optimistic,
Projecting 7% to 7.4% growth for FY27.
citing sustained non-inflationary expansion.
Right.
But if corporate India looks at that 2.4% agricultural growth,
They might hesitate.
exactly, they might hesitate to build new factories if they think rural demand is going to be weak.
That is the ultimate stare-down happening in the Indian economy right now.
A stare down.
Yes. Private investment, represented by gross fixed capital formation, is estimated to accelerate to 7.1%.
Companies need to start expanding capacity, buying machinery, creating jobs.
And domestic corporate balance sheets are the healthiest they have been in a decade.
Bank balance sheets are clean, too.
The runway is completely clear.
So it's all on them now.
If corporate India hesitates now, out of fear of rural demand or global volatility, the 7.6% growth rate we are celebrating today will be very difficult to maintain in the coming years.
The government has built the stadium.
Now the private sector has to show up and play the game.
Speaking of global volatility and companies having to drastically adapt,
Let's pivot to the tech sector.
the absolute earthquake that hit the technology sector this month.
It's been brutal.
The Nifty IT index plunged 19.5% in February alone.
That wiped out nearly 5.7 trillion rupees in market capitalization across its top 10 constituents.
Just to put that in perspective for you, that is the steepest monthly fall since September 2008.
Right in the middle of the global financial crisis.
Now, AI replacing coders is a trope we've heard for a couple of years.
We've been talking about it endlessly.
Why the sudden, violent panic today? What was the actual trigger?
The trigger was the realization that the threat is no longer theoretical.
It's real.
It is highly specific and
Yeah.
currently operational.
Anthropic.
Yes, Anthropic.
Yeah.
A leading AI company, they announced a tool called Claude Code.
And the specific capability of Claude Code that caused this market crash is its ability to successfully automate the modernization of legacy COBOL systems.
That's the key right there.
To understand the panic, you really have to understand the foundational business model of traditional Indian IT and global outsourcing.
Let's unpack that because it's crucial.
When people think of Indian IT, they often think of customer service or app development.
Sure.
But the real bedrock is COBOL, isn't it?
Yes, so COBOL.
It stands for Common Business-Oriented Language.
It is an ancient programming language created in the late 1950s.
And most people assume it's obsolete.
But it is actually the plumbing of the global financial system.
Trillions of dollars of daily transactions, airline ticketing systems.
The federal government databases.
They still run on millions of lines of COBOL code on massive mainframe computers.
And the problem is that the original engineers who wrote this code are either retired or deceased.
The code is often undocumented.
It is a massive, fragile web.
So the traditional IT business model for the last 3 decades has been charging global banks billions of dollars a year
To deploy armies of engineers.
just to maintain, patch, and very slowly update this fragile web.
Billing them by the hour.
Right. They operate on time and materials contracts.
The longer a project takes and the more engineers it requires, the more revenue the IT service company generates.
Modernizing a core banking system from COBOL to a modern cloud-based architecture using Java or Python,
Traditionally takes years of painstaking manual translation, testing, and debugging.
it is a cash cow.
A massive cash cow for IT service providers.
Now suddenly you have an AI agent like Claude Code.
That can look at decades-old, undocumented COBOL
Understand the underlying business logic perfectly.
and rewrite it into modern architecture in a fraction of the time and cost.
It's devastating. IBM's stock plummeted, wiping out $30 billion in market cap almost instantly.
Because IBM is one of the largest players in legacy mainframe maintenance.
The billing by the hour model for maintenance is being fundamentally disrupted by an algorithm that can execute the task instantaneously.
Yes.
It's like finding out the toll booth you've been operating on the only bridge into the city for 20 years.
Has just been bypassed by a free, newly constructed teleportation pad.
Exactly. Why would a bank pay for 5,000 engineering hours if Anthropic can do it in an afternoon?
And this disruption isn't happening in isolation.
No. At the exact same time Anthropic made this announcement, OpenAI finalized a record-breaking $110 billion funding round.
Valuing the company at $730 billion.
The sheer scale of that capital is breathtaking.
Amazon, SoftBank, NVIDIA, they are writing massive checks.
This indicates that the foundational infrastructure layer of AI is consolidating around a few massive players with unlimited capital and computing power.
They are building the operating systems of the future.
And traditional IT companies are caught in the crossfire.
They really are.
But I'm looking at our sources, and it is not entirely a doom and gloom scenario for everyone.
It's not.
While the old model is burning, a new one is being forged at incredible speed.
AI-driven revenue for the Indian IT sector is actually expected to hit $10 to $12 billion in FY26.
And Anthropic, the very company that caused the panic with Claude Code, is actually partnering with Infosys
They are collaborating to build dedicated AI centers of excellence.
to deploy specialized AI agents for telecommunications and financial services.
So they aren't just destroying the old model.
They are actively building the new one with the traditional players.
This is the hyper-evolution phase.
The companies that survive this 19.5% plunge won't be the ones trying to protect their legacy maintenance contracts.
The survivors will be the ones who successfully pivot from selling engineering hours to selling AI-driven outcomes.
They have to move from time and materials pricing to fixed price or value-based pricing.
Right. If an IT company can use Claude Code to modernize a bank's architecture in 1 month instead of 3 years,
They shouldn't charge for 1 month of hours.
they should charge for the massive value of the outcome delivered.
It changes the role entirely.
Completely.
The Indian IT sector's role is shifting from writing the code manually to orchestrating the AI agents that write the code,
They become the conductors of the AI orchestra.
ensuring security, compliance, and integration.
Because the enterprise client is too terrified to plug OpenAI directly into their customer database?
Right. They need that middleman they trust.
It is a terrifying transition, which is why the market panicked and dumped the stocks.
But that $10 to $12 billion revenue projection shows the bridge to the future is already being built.
You have to endure the demolition to get the new skyscraper.
And importantly, all of this AI capability, the Claude codes, the OpenAI models,
Doesn't exist in the ether.
no, it requires massive physical infrastructure.
It requires silicon.
The software earthquake we are seeing is completely dependent on the hardware reality of semiconductor manufacturing.
Which brings us perfectly to our next section.
Shifting supply chains, chips, trade pacts, and tariffs.
Let's start with the physical reality of that silicon.
The Prime Minister is debuting Micron Technology's new semiconductor plant in Sanand, Gujarat.
This officially puts India into the global chip makers club.
When this plant hits full capacity, it will account for 10% of Micron's worldwide production.
It's going to create 5,000 direct jobs.
And to get them there, the Indian government provided a massive 50% subsidy on the plant costs.
We are talking about a facility the size of 6 to 7 cricket fields.
Just for packaging and testing memory chips.
We need to define exactly what is happening at this plant.
Because the semiconductor supply chain is highly complex.
It is. This is an AT&P facility.
Assembly, test, marking, and packaging.
It does not fabricate the raw silicon wafers from scratch.
Okay, that's an important distinction.
Fabrication, or a fab, requires tens of billions of dollars.
And incredibly delicate ecosystems.
Currently dominated by companies like TSMC in Taiwan.
Right. So what does the Micron plant in Sanand actually do?
It takes the completed silicon wafers imported from fabs abroad, cuts them, assembles them into final chips,
Rigorously tests them.
and packages them into finished memory products like solid-state drives.
So if it's not the holy grail of full fabrication, why is the government throwing a 50% subsidy at it?
Are we just paying to be a high-tech packaging center?
Yeah, is that all it is?
No, it is a deliberate strategic stepping stone.
Okay.
You cannot build a full fabrication ecosystem without having the downstream AT&P infrastructure in place first.
That makes sense.
Furthermore, the Micron plant is the physical manifestation of geopolitical de-risking.
De-risking from China.
Yes. Micron has been actively reducing its dependence on China, especially after the Chinese government prohibited Micron products from being used in critical infrastructure in 2023.
Citing cybersecurity risks.
Right. India stepped in with aggressive subsidies under its semiconductor scheme to capture that fleeing capital.
It proves to the world that India can execute on a highly complex, globally integrated hardware manufacturing project.
Once you prove you can do AT&P at scale, you build a talent pool and the logistics networks required to eventually attract full fabrication facilities.
And while we are building these massive physical plants to secure supply chains,
The rules of global trade that govern where those chips are sold are being tossed out the window.
let's look at the absolute chaos unfolding in the United States regarding trade policy
The situation with the U.S. is a masterclass in trade volatility.
and the limits of executive power.
The U.S. Supreme Court just struck down President Donald Trump's use of the IEPA to impose country-specific tariffs.
Wait, hold on a second. IEPA.
Yes.
For our listeners who aren't trade lawyers, what exactly is the president invoking there, and why did the Supreme Court stop him?
IEPA stands for the International Emergency Economic Powers Act. It is a powerful law typically used by the president to impose economic sanctions on hostile foreign nations or terrorists during national emergencies.
So President Trump attempted to use this national security tool broadly to impose specific punitive tariffs on individual countries over trade imbalances.
Yes. And the Supreme Court ruled that using an emergency sanctions law to dictate standard trade policy likely violated equal treatment principles.
And exceeded executive authority in that specific context.
Correct.
So the president's attempt to use a sledgehammer was blocked by the courts.
But he didn't back down.
No, he just grabbed a different tool from the shed.
Exactly. Trump's immediate retaliation was to utilize Section 122 of the Trade Act of 1974.
This section specifically allows the president to deal with large balance of payments deficits.
Right. So under Section 122, he slapped an across-the-board 10% tariff on everyone.
With threats to raise it to 15%.
He couldn't target specific countries with IEPA, so he blanket taxed the entire world.
But here's the massive irony in the reports today.
It's quite something.
This Supreme Court ruling, blocking his country-specific tariffs, combined with his new 10% flat tariff, actually helps India in the short term.
It does.
Our effective tariff rate on exports to the U.S. drops from 22.3% down to 13.9%.
China sees a massive drop, too, down to 26.9%.
So Trump getting blocked by his own Supreme Court inadvertently gave Indian exporters a massive discount on U.S. tariffs.
Temporarily, yes.
Yeah.
It is a brief window of relief.
Very brief, probably.
The analysis strongly warns that the Trump administration is already plotting to use other, more robust mechanisms.
Like what?
They are looking at Section 232, which allows tariffs based strictly on national security threats to specific industries like steel or aluminum.
And Section 301.
Yes, which is designed to penalize countries for unfair trade practices or intellectual property theft.
Section 301 investigations take time, but they grant vast discretionary power to reconstruct those high country-specific tariffs.
Commerce and Industry Minister Piyush Goyal is taking a very cautious stance.
He noted that the interim trade deal India recently finalized with the U.S. has a rebalancing clause.
If the U.S. changes tariffs under Section 301, India is legally permitted to modify its commitments and retaliate.
It sounds exhausting for an exporter.
I can't imagine.
You go to sleep with a 22% tariff, wake up to a Supreme Court ruling giving you a 13% tariff.
And spend your afternoon worrying about a Section 301 investigation raising it to 30%.
Let's contrast that executive-driven volatility with Europe.
On the European front, the news is entirely different.
The India-EU free trade agreement is nearing reality.
Yes, and the contrast in approach is stark.
The EU FTA text now includes a finalized annexure for model mediation procedures.
This is a massive structural win.
It provides a fast-track, predictable, and legally binding way to resolve trade disputes without entering years of arbitration.
Companies like Greaves Cotton, a major Indian engineering and mobility firm, are thrilled.
Their CEO, Parag Satpudar, explicitly stated that the FTA brings policy predictability,
allowing them to make long-term investment plans and target 20% of their total revenue from exports to Europe.
So if you are a manufacturer, you are cheering for the methodical, boring predictability of the EU free trade agreement,
while keeping a very close eye on the volatile, unpredictable trade actions coming out of Washington.
Which leads us into zooming in on specific sectors within India that are navigating these global headwinds and domestic policies.
We have a segment we are calling Sector Spotlights and Regulatory Red Flags.
We are seeing a real tale of two economies here based on government intervention.
Let's start with a massive winner, the power and infrastructure sector.
Hitachi Energy India's stock has surged 54% in a single month. Why?
The Hitachi Energy surge is a classic example of a massive, unstoppable structural tailwind intersecting with specialized corporate capability.
India is undergoing an unprecedented power sector transition,
aiming for an installed renewable energy capacity of 67 gigawatts by 2032.
You can build all the solar farms in Rajasthan and wind turbines in Gujarat you want.
But you have to move that power to the industrial centers in Maharashtra and Tamil Nadu without losing half of it in transit.
And Hitachi Energy specializes in high-voltage direct current, or HVDC, equipment.
HVDC is the superhighway of electricity.
It allows massive amounts of power to be transmitted over long distances with minimal loss.
So regardless of short-term economic fluctuations, the physical grid must be updated to handle that load.
The government has mandated the targets, and Hitachi is selling the shovels for the gold rush.
Their profits are soaring, up 241% year over year.
That is what a successful structural policy looks like.
But let's contrast that with a sector where government intervention has perhaps backfired or created localized chaos.
Take the Auto Production Linked Incentive, or PLI, scheme.
We saw PLI work to attract Apple and Foxconn for mobile phones.
But a new report by the Center for Domestic Economy Policy Research, or CDEP, claims the PLI scheme has actually distorted the electric two-wheeler market.
Didn't PLI work for electronics? Why is it failing EVs?
The CDEP report provides a brutal critique of policy design.
The production-linked incentive scheme is designed to reward companies with cash payouts based on massive incremental sales of domestically manufactured goods.
In electronics, where a few massive global players dominate, it works.
But the electric two-wheeler market in India is highly fragmented and driven by agile, innovation-led startups.
The CDEP report argues that the auto PLI scheme's stringent investment and volume criteria essentially excluded these innovative startups,
favoring legacy incumbent automakers who could easily meet the volume thresholds.
So by setting the entry bar too high, the government essentially subsidized the giants and starved the innovators.
Exactly. The report notes that this distortion failed to create true export competitiveness,
pointing out that an astonishing 77% of India's EV two-wheeler export volumes are actually driven by non-PLI models.
The models receiving the massive government subsidies aren't the ones succeeding in the global free market.
It is a stark reminder that just throwing incentive money at a sector doesn't automatically guarantee the desired outcome if the policy design favors scale over innovation.
That is a critical regulatory red flag for investors betting blindly on subsidized sectors.
And speaking of red flags, the financial sector had a wild day regarding corporate governance and risk.
The CEO of Fino Payments Bank, Rishi Gupta, was arrested.
The bank was quick to issue clarifications to the stock exchanges, stating that the arrest was over GST violations committed by the bank's external business partners.
Not the bank's own internal compliance.
But the optics of a banking CEO in custody are terrible.
It highlights the extreme danger of governance by association in modern Indian banking.
Payments banks rely on massive, decentralized networks of banking correspondents and third-party merchants to reach rural customers.
If those third-party partners commit tax fraud or GST violations, law enforcement agencies are increasingly willing to hold the central corporate officers accountable.
For failing to implement adequate oversight and know your customer or KYC protocols on their partners?
Even if the bank itself is financially sound, the reputational damage and regulatory scrutiny that follows an executive arrest can paralyze operations.
And the regulatory risks aren't just coming from national law enforcement.
Localized politics are creating massive headaches.
In the microfinance space, the state of Bihar just passed a new bill to regulate money lending,
aiming to prevent coercive recovery actions by lenders.
The Microfinance Institutions Network, MFIN, is scrambling to assure everyone that RBI-regulated entities are legally exempt from this new state law.
Like major banks and registered non-banking financial companies.
But the mere introduction of the bill has sparked severe fears of loan defaults.
Analysts are warning it could embolden borrowers to delay payments.
This is a fascinating intersection of local politics and national financial stability.
You have to understand the psychology of microfinance.
It is entirely unsecured lending. There's no collateral.
It relies entirely on joint liability groups and a strict culture of repayment.
When a state government passes a law aimed at preventing coercive actions and local politicians start talking about protecting borrowers,
it changes the borrower's psychology on the ground instantly.
Even if the law technically doesn't apply to RBI-regulated lenders, the local borrower doesn't know the difference between a registered NBFC and a local money lender.
They just hear that the government is stopping collections.
We saw this previously in states like Assam and Andhra Pradesh.
Political rhetoric or local laws can trigger massive, contagious default cycles.
It proves that regulatory risk in India isn't just about what the central bank in Mumbai is doing.
Localized political actions can severely impact nationwide lending models.
That is a crucial warning for anyone investing in the microfinance sector right now. Keep an eye on regional politics, not just national interest rates.
Let's look at one more incredible contrast in how different investors are viewing the exact same regulatory and governance risks.
Norway's sovereign wealth fund, Norges Bank,
which is a massive player globally with over $1 trillion in assets.
They completely excluded Adani Green Energy from its portfolio.
They sold off roughly $44 million worth of shares over governance concerns.
But at the exact same time they were dumping it, domestic Indian mutual funds were eagerly scooping it up,
buying $500 million worth of Adani Green shares since the beginning of the year.
Domestic funds have increased their exposure to the Adani Group 10 times over.
This represents a massive decoupling of risk assessment based on geography and mandate.
Foreign capital, particularly sovereign wealth funds with strict ESG, environmental, social, and governance mandates,
view the regulatory and governance history of the Adani Group, particularly following short seller reports over the past few years, as a prohibitive risk.
Their compliance departments simply cannot hold the stock.
However, domestic mutual funds, operating closer to the ground, seem to be pricing in a completely different reality.
They see the group's undeniable alignment with the government's massive infrastructure and green energy build-out.
It's essentially foreign capital saying, the paperwork makes us nervous.
And domestic capital saying, look at the massive physical size of the solar farm we are buying.
Domestic funds are willing to absorb the perceived governance premium because they see the physical assets generating cash flow and the structural tailwind supporting them.
It is a stark reminder that risk is completely subjective.
Exactly. It depends entirely on whether your primary mandate is strict global compliance or capturing domestic structural growth.
Okay, let's bring it all home with our final section: media, markets, and consumer shifts.
First, the entertainment landscape is shifting.
Paramount is set to acquire Warner Bros. Discovery's Indian operations.
as Netflix apparently stepped back from the race.
This is a massive consolidation of Hollywood intellectual property under one roof in India.
This merger isn't just about who streams Batman, Harry Potter, or Game of Thrones.
It is entirely about bargaining power and distribution leverage.
Paramount, by absorbing Warner Bros. Discovery's catalog, gains significant leverage in licensing negotiations.
Instead of selling their content piecemeal to local Indian OTT platforms like JioCinema or Amazon Prime Video,
They now control a massive block of premium Western content,
it prevents the fragmentation of Hollywood IP.
which protects their pricing power in a market that is notoriously highly competitive and price-sensitive.
They can dictate terms to local exhibitors and streamers much more effectively.
And speaking of a price-sensitive consumer, let's look at the actual financial health of the everyday Indian.
The bank credit data we reviewed shows that retail loan growth is being heavily driven by gold loans.
Which are up a staggering 17.2% year over year.
People are literally taking their family jewelry to the bank to pledge it for liquidity.
Meanwhile, corporate credit to large industries grew at a very sluggish 5.5%.
So the consumer is leveraging their personal, generational assets, while the big corporations are holding back on borrowing.
This is a critical, flashing indicator of underlying economic health that ties back to our very first point about GDP and private capex.
The surge in gold loans tells us two contradictory things.
First, the Indian consumer remains resilient and is finding creative ways to maintain consumption or manage cash flow.
But second, and more importantly, it indicates a level of deep financial stress.
You do not pledge household gold, which holds immense cultural significance in India, unless you need immediate liquidity.
Liquidity that you cannot get through standard, unsecured personal loans because your credit profile is stretched.
When you pair this stressed consumer leveraging gold with the sluggish 5.5% growth in corporate credit to large industries,
It reinforces our earlier concern. The private capital expenditure cycle is not yet firing.
banks are finding it easier and safer to lend against tangible gold to stressed individuals than to lend for new factories to cautious corporations.
The economy is walking on one leg.
And how is the stock market digesting all of this macro tension, the IT crashes, and the trade volatility?
The Sensex and Nifty closed out a highly volatile February with another 1% drop.
It's their third consecutive month of declines.
We talked about the IT sector getting hammered, but even the broader market is feeling the weight.
The small cap index in particular is flashing mixed signals.
Analysts are saying the overall index level valuations look expensive compared to the 5-year average.
But if you look closely, you can still find quality individual small cap stocks trading at sub-20 price-to-earnings ratios.
The market is in a classic period of churn and digestion.
The broader indices are being weighed down by the massive IT sector reset.
And the fading of immediate foreign portfolio inflows due to global interest rate uncertainties.
However, the internal dynamics are shifting from a momentum market to a stock picker's market.
You cannot indiscriminately buy a basket of small caps anymore, expecting them all to rise.
The easy money generated by post-pandemic liquidity has been made.
But for the discerning investor, this recent volatility is actually healthy.
It has created pockets of value where quality companies with strong balance sheets, tangible earnings visibility, and domestic-focused business models are becoming attractive again at lower valuations.
The key is to ignore the high valuation hype and focus on the fundamentals of the individual business.
We have covered a massive amount of ground today.
From the changing math of the GDP and the mechanics of double deflation, to the AI threat in IT, to the physical reality of chip plants and the volatility of trade tariffs.
Let's build a playbook for the listener today.
If we distill all of these sources into the most critical developments for a long-term investor, where do we land?
On the macroeconomic front, the baseline has shifted.
The reset to the 2022-23 base year proves that real economic growth is incredibly strong at 7.6%.
Largely due to formalization and better data capture.
But the nominal GDP is actually lower than expected, which slightly squeezes the government's fiscal deficit math, pushing it to 4.5%.
That means the government has to tighten its belt.
Which perfectly sets up the second major takeaway. Private capex is now mandatory.
With government spending growth flattening out at 6.6%, the baton must pass.
The consumer is stressed, relying on gold loans. Corporate investment is absolutely critical to driving the next phase of India's growth.
If they don't build, the growth slows.
And on the tech side, the paradigm has shifted overnight.
AI tools like Anthropic's Claude Code automating legacy COBOL systems represents an existential threat to traditional IT billing models based on engineering hours.
The industry is being forced into a massive, painful pivot toward AI agent revenue streams.
It is adapt or die for IT services.
But that software revolution relies on hardware, which is our fourth point. The hardware manufacturing boom.
Micron's massive new Sinan plant opening proves that India can successfully execute on massive global-scale semiconductor packaging and ATMP manufacturing.
De-risking global supply chains away from China.
And as we manufacture more, we have to navigate the shifting trade winds. Point 5 is U.S. tariff volatility.
The U.S. Supreme Court ruling temporarily lowers India's effective U.S. tariff to 13.9%.
But President Trump's use of Section 122 tariffs and threats of further action mean constant, unpredictable U.S. trade uncertainty.
You have to compare that to point 6, EU trade predictability.
In stark contrast to Washington, the impending India-EU free trade agreement, with its model mediation procedures, offers a safer, methodical, long-term catalyst for export-heavy manufacturers.
Looking domestically at specific sectors, point 7 is the power infrastructure supercycle.
Massive national targets of 67 gigawatts by 2032 and necessary grid upgrades are creating multi-year structural tailwinds.
For companies like Hitachi Energy, providing high-voltage direct current equipment.
But point 8 reminds us that government intervention isn't always perfect. PLI scheme nuances.
The auto PLI scheme is facing severe backlash for allegedly stifling startup innovation in the electric two-wheeler market by favoring massive incumbents.
Policy design matters.
And regulatory risks are everywhere. Point 9 focuses on microfinance and regional risk.
Localized politics, like Bihar's new anti-coercion microfinance bill, can create sudden, severe headwinds for unsecured lending.
By altering borrower behavior and triggering default cycles, regardless of national banking laws.
And finally, point 10. Foreign versus domestic capital divergence.
There is a massive decoupling in risk appetite.
Domestic mutual funds are aggressively buying assets, like Adani Green, focusing on physical growth.
While foreign sovereign wealth funds are actively dumping them over ESG compliance concerns.
The definition of risk depends on who is writing the check.
Those are the crucial takeaways for navigating this landscape.
But before we sign off, I want to leave you with one final thought to mull over. Returning to the AI earthquake we discussed.
Let's hear it.
We spent a lot of time today talking about Anthropic's AI instantly rewriting legacy bank code and bypassing thousands of engineering hours.
Right.
If an artificial intelligence can now write, analyze, and rewrite the foundational code that runs global banking and logistics in a matter of seconds for fractions of a penny,
we have to deeply ask ourselves, what constitutes a defensible economic moat for a business tomorrow?
if the execution of complex technical tasks effectively becomes free and instantaneous, the only things left of true, irreplaceable value are the trust of the consumer
The physical assets you control in the real world.
and genuine human relationships.
That is a profound thought to end on.
As the cost of intelligence and execution trends toward zero, the premium on trust and physical reality skyrockets.
The value shifts from the code itself to the trust in the people deploying it. Thank you for joining us on this deep dive.
Keep learning, keep questioning, and we will catch you on the next one.